Welcome to the Corlin Economics Report, a weekly look at financial and political topics relating to asset-based investing. Guests on this program pay no fees to appear, and guests and hosts disclose any equity interest in companies profiled. Now, the Corlin Economics Report.
Hey everyone, welcome in to the weekend edition of the KE Report. Again, this weekend's edition, we are going to be focusing on the resource sector, commodities broadly, driving down into the stocks because, well, we're still in a very good environment for these commodity stocks, and we're continuing to see money broadly come into the sector, as well as some financing news and other M&A activity. I think it's all positive for us investors that have been in these sectors waiting for these breakouts to happen. Now they're all happening. So in the first half of this show, we're going to chat with Joe Mazumdar, talking more about the resource sector, more of the metals area. And in the second half of the show, switching over to the energy sector with Dan Steffens, and a big focus there on natural gas's recent move higher. Now, Joe Mazumdar, editor of Exploration Insights. Joe, it's always interesting hearing what you're seeing in the market. And quite frankly, look, we have silver above $30, gold right around $2,400 as we're recording this. Copper was just above $5. It has pulled back a little bit as we're recording this on Wednesday, but overall, strong metals prices. Investors are starting to take notice. Joe, where do you see some of the best opportunities in the stocks, the underlying equities, understanding that for these main metals that I just talked about, precious metals and copper being the base metal, this is a move that's still pretty early on, only about 3 months long for the precious metals. Where are the best opportunities out there?
Well, interestingly, we were seeing moves, and for me, the best indication that we would be in this environment several months ago, the leading indicator for me was the M&A that we were seeing. Like the M&A that we were seeing in 2023, some of it was transactional, companies getting together as major shareholders in both companies sought to reduce their G&A spends and just say, well, here, you guys get the same amount of money, cut management, and just prioritize the assets that you guys have combined. And those sort of transactions didn't make any money for any shareholder, but it gained them a bit of liquidity, prioritized assets, and more importantly, combined working capital. So even though there was a bit of M&A, that kind of M&A really is not a good indicator of anything more than desperate times. But now we're seeing more M&A towards the latter part of the last year and this year with multiple bids and actual premiums where shareholders are actually making money. So on a positive note, we saw Asino, and that was approved by the Canadian government, and that acquisition by a state-owned Chinese company went through. We saw the Greenstone bidding for the 40% ownership of Orion Finance Group of the Greenstone mine, and that was multiple bid because Gold Road was also interested. So those sort of multiple bids that we're seeing are really positive for me in terms of knowing that the industry is seeing the lack of assets out there. People need to fill their portfolio. People want exposure to rising metal prices. And that really was a good signal of what we're seeing right now. And both in copper, gold, and now in silver.
Yeah, Joe, it's nice to see the animal spirits coming back to the space. And in addition to the ones you mentioned, there was also both Silvercorp and Perseus going after OreCorp, where you had a bidding war there. And then when Silvercorp didn't win because Perseus got the deal, they went and acquired Adventus Mining. And then you just saw G Mining take over Reunion Gold. So there's a lot of positive momentum going where investors are actually it's freeing up some capital to rotate around the sector, but some investors are actually making money on these premiums finally. So instead of take unders, we're finally seeing some takeovers. Do you think that will get more of a speculation into the development stage companies that have big assets? They've got maybe some economic studies in place. Do you think we'll see some of those finally start getting traction with investors as they could be the potential next takeover candidates?
Yes, because if we see your Adventus, advanced stage, base metal, copper dominant, volcanogenic massive sulfide in Ecuador being taken out, and then the other one you were talking about was Reunion Gold. That's advanced exploration, not quite development in Guyana. as well being taken out. So now we're seeing that sort of development, but we're not seeing it like a Sabina-like acquisition where shareholders are flat in terms of a return, 30% premium, if that, to a 52-week low. We're seeing a premium on top of sometimes 52-week highs. So that's the kind of things we want to see. And thankfully, we're seeing that now.
Joe, what kind of assets do you think are next on the table for M&A then? These do seem to be more advanced assets. Anything on your radar, either jurisdictionally wise or actual project wise?
So in terms of high risk, high reward, exploration is now looking much better because I'm seeing a lot more financings and they're coming almost every week now. But when I was seeing financings previously, the problem was with a lot of these financing transactions coming off of 52-week lows, they had to offer also long dated warrants, not much of a premium to the unit. So even though they could fund and there was money out there, the money really was ripping into the share structure of the company going forward. If you already owned the share, it wasn't a great transaction. If you were coming in on that transaction and rising prices, it was a good transaction for you to come in on, but it wasn't a great one for the people that were already in. I think going forward, we might see better transactions in terms of the equity space. Right now, I prefer just to buy in the market. I don't have the 4-month hold. I'm not that keen on the warrant. And for me, the companies that don't have to issue these warrants and don't have to issue them at a small premium with a long dated warrant, that sort of indicates to me that it's a better asset as well.
Well, and just thinking of the capital markets, having a little bit of a capital window here to raise funds for some companies. There's a lot of companies that already luckily cashed up ahead of time, or maybe they had 2 or 3 years of money raised, so they were able to do some drilling this year. But we've noticed a general trend of a lot of companies being really late to the game this year, or not even having a work program yet because they haven't raised, or the ones that have raised taking a more tentative stance and saying, hey, instead of doing 20 or 30,000 meters of drilling, we're going to do 10,000, or instead of 10,000, we're going to do 5,000, and we're not going to try to do resource drilling. We're going to try to go make a new discovery. Do you think some of the companies are, I don't want to say it, but maybe a contrary indicator that now that the metals prices are breaking out and now that investors are coming back, they finally decided to be more shrewd in their capital and they blew a lot of money when nobody was watching? Do you think that maybe it's actually a good counter indicator?
Yeah, I don't know. These guys are driven by the people that give them money. And so the people that give them money say, oh, I like this one. Why don't we drill that? Because that's what I'm interested in. And so if you're given 2, 5 million, whatever, you're going to focus in on what those people that gave you the money are focused in on. If you got weak hands, where I see strong hands is that they've got a program. They know what they're doing. They're selling that program. They're selling their assets to these potential investors, and that's what they're buying into. They're buying into management. They're buying into the asset. They're buying into this news flow. Other people have assets, but then the people that are giving them money would like them to do something specific, and they'll just take whatever money they can get. Just because, like you said, during PDAC, when people usually tend to raise money, there wasn't a lot of money raised then. And as we get closer to the North American field season, especially in Canada and the northern parts of Canada, these guys are desperate to raise money because they want to get the rig, they want to put the drill contract out, they want to get their people in the field. And some people haven't even hired people for the field season. And once somebody comes in and hires them, then if you're really late to the financing window, there might not be many people for the field season to help you. And also, you might get the worst drill contractor.
All right, Joe, that's all the time we have for this segment, but we're having you back on next segment, so everyone stick around. We're going to be right back with Joe Mazumdar, continuing to focus on resource stocks because, hey, we're all invested in them. Let's find which ones have the best opportunities. Yeah, it's so interesting just to see how slow a lot of these companies are. But hey, that's what a 4-year bear market does when money is tight and they weren't getting any value for the work they were doing, tying that into ounces in the ground value. Boy, oh boy, we saw a depressed price for a lot of the ounces in the ground. Now, an argument being there's a lot more ounces in the ground, so that money can spread out a little bit more across all these different assets. But we have seen generally a revaluation here. Joe, what do you do when you're looking at these resources? And you obviously hear from companies these comparison slides saying, look what these companies are valued at and their ounces in the ground. Look what we're valued at, obviously lower, and our ounces in the ground. How do you compare ounces in the ground and how much they should be valued for?
Well, if we take, let's say, a feasibility study that just came out from a company in northern Quebec and a very low grade gold and sort of, I don't even want to call it a copper asset because the grade was like 0.06%. They came out with their feasibility study and they were duly punished by the market, even in a rising gold environment. Why? Because their return was low and the capital ran up quite a bit, partly because their last study was during COVID and they increased their throughput capacity quite a bit. So those kind of low economic return projects are still getting punished in the market. So you really, when you look at EV per ounce, or if that's a metric you're looking at, if you see the asset and see that the potential to develop something economic that somebody might be interested in, meaning a suitor, is low, that EV per ounce calculation might just stay the same. It's better probably to put your money into the ones that are a little bit more valuable, because in a good market, those would still be the ones that have less downside risk, even because we know markets are volatile. There's not a lot of suitors out there because of the consolidation we've had. So you want to get the ones that have probably a higher probability of getting acquired.
Well, let's also talk about potential red flags for ones that you think actually won't get acquired, because there's a lot of companies that have ounces in the ground, millions, and many times in gold or sometimes hundreds of millions in silver. And they've been on the sales rack since the last cycle and nobody's taken them up on it. And so a lot of these companies will flag that, hey, we have all these ounces in the ground and we should be revalued higher. But they're really faced with the decision of, can I raise the money and build this thing, or will somebody please take us out? And a lot of them can't raise the money, so they're perpetually waiting for a takeout. What are some of the red flags you look for, Joe, having spent time in the industry, working with majors, looking at acquisitions? What would cause you to say no to a project if you were in that role?
Well, how quickly could you permit it? What would be the upfront capital? Red flags, the metallurgy is difficult. We don't do that kind of metallurgical process. The footprint is so big, we might have problems with either the First Nations or a local community, those social license to operate issues. Let's take something like Casino. Like their Rio Tinto put a footprint into Western copper and gold. The grade is not great. It's a semi-remote project and it requires a lot of capital, more than $2 billion probably in the end, Canadian. But they're doing LNG because obviously the Yukon, that part of the Yukon or any part of the Yukon doesn't have any power. What Rio Tinto seems to want is for that project to be green. And so they're willing to hang on to this project that's low grade, but potentially for the opportunity in the long run to get connected to the BC grid. But connection to the BC grid would require about $1.7 billion. So I don't know how that's going to happen or when that's going to happen. But you do that option because you probably think that, oh, here's a project in the Yukon that I can get permitted. So the jurisdiction's good. I'm okay with the grade in a rising copper and gold environment, but I'd really like to get green copper. So what's that going to take? Each one can have a different slant in terms of why you're acquiring it. You might acquire a project because you have a plant and you might need more feed. You might acquire a project because you already operate it and you want a higher ownership. That would be Equinox and the Orion transaction. When I was with Newmont, we did a similar thing with, I think it was Anglo Gold Ashanti at the time owned the other third of Boddington. And so we acquired that to get full ownership of Boddington. Those are some of the easiest transactions to do because the due diligence you don't have to really do because you're already the operator. You already understand the deposit. You already understand the financial metrics. All you're doing is acquiring the other piece. So the ability to do that transaction is very quick, and the ability to integrate the transaction, which sometimes takes a long time, would be very quick. So every transaction is a bit different. And like I said, on the demand side, we've got less suitors. So we're even more suitor specific in terms of what are these suitors looking for.
Yeah, that's such a good point. Less suitors out there. But hey, Joe, I want to switch focus just a little bit and talk about silver because silver has broken out above $30 an ounce. And we all know how much speculation can come into silver as well as the silver stocks. A number of the silver primary miners, they should be making money now when they were dealing with all-in sustaining costs of over $20 an ounce. Are you enticed at all to get into the silver focus, silver specific stocks?
Well, I went into a silver advanced explorer in Northwest Argentina, in a place where I've worked previously in the 90s, so I'm familiar with the jurisdiction. I'm going to visit it in June. And that's got a resource, that's got a higher market cap. Like it's not a 20 million, 30 million, it's more like 200 million. But with that, there's a resource there. It's silver dominant, so it's not like it's a 30% silver, and it's in a place where you can get permitted. So those are the sort of things I'm looking for in the silver space. But also in the silver space, I do have royalties, smaller royalty companies with silver exposure. And so that's another way I'm playing this as opposed to playing the producer all the time. I'm looking at these smaller royalty companies that have more leverage, that have exposure to the silver, copper, gold trifecta. And so that's another way I'm playing this.
Yeah, that's an interesting point on the royalty companies. We don't really give it enough airtime as far as ways to play things like copper or silver, not just gold. And some of them are more diversified. And if you dig into their assets and what they actually have royalties on, some of it is coming off of silver or copper and not just gold. But it's a great way to play the space. A lot of people would say, well, Joe, there's not much leverage in a royalty company, but in some of the price spikes that we've seen, like in 2016 or even in the 2020 and 2019 to 2020 run, some of the royalty companies, the smaller ones, did quite well, as did the large ones. What would you say to people that say, "Oh, I don't want to position in royalty companies because there's not as much upside"?
I'll give them an example. Origin, I took a position when they fell based on the quality drilling that obviously was very negative, and they went from, I don't know, they were up to a buck 50 at that point, and they fell back down to below 30 cents. I was about to sell them, but then I saw that level at 30 cents and I thought, well, this is fairly valued here because they have this royalty that's not producing yet, this 2% NSR on the Ermitaño project with First Majestic. And I've held that company for 5 years or more. In the portfolio, we have one position, I think, that's almost 10 years. I really like the management team, and they did make an acquisition, the Renaissance Gold acquisition, which gave them a 1% NSR royalty on the Silicon project. The Silicon Merlin project went from zero in terms of ounces to 13 million ounces. That stock has gone from that 30 cents to hitting a new high of about a buck 25. They never changed their share structure. They never had to go to the market. Why? Because they had that other 2% NSR on Ermitaño. So they had cash flow coming in. So when everybody saw that, oh, look at how Silicon's going bigger, oh, well, these guys are going to go to the markets. Well, why do they have to go to the markets? One is that they make money off of their prospect generation business. Two, they get cash inflow from their 2% paying royalty. Three, they don't have to spend a cent on drilling anything to grow a resource from 0 to 13 to 14 million ounces. And right now, the price of drilling a meter in Nevada is like 450 to 500 bucks a meter US. So imagine that. Imagine if you found something, then the next thing you would have to do is go back to the market to raise this kind of cash to drill it. But imagine a company that doesn't have to do that.
Yeah, well, it's one of the benefits of the royalty model, right? Is that they are not so cash intensive and they don't need to keep outlaying a bunch of cash. But Joe, look, there's a lot more small royalty companies out there, and all these small royalty companies have, let's say, a handful, maybe a dozen at most royalties that pay them money. They really don't make huge amounts of revenue, maybe $10 million a year, but many of them are even under that figure. But they have a lot of these development or exploration assets in their portfolio. How do you filter through and do your due diligence on these companies? Obviously, paying some attention to the assets that are cash flowing right now, but analyzing all these other assets in their portfolio that these companies always say they'll give us value, but we just don't know the timing.
Yeah, I would not, like anything, just pick a sector, whether it's exploration, development, advanced exploration, or production, and just say, oh, just stick to this sector and buy everything in here. You're going to have to filter. And if you want to filter on the basis of finding something like Origin, primary is management, and management filters what assets they purchase and their own dilution. And Origin's management has been excellent in doing that. So that's what you want to prioritize, and their ability to filter and acquire, and then also not spend a lot of money. So they've gone from trying to do these joint ventures where they end up with 30% of the asset and the other company owns 30, and then they have to buck up money in a joint venture. They don't do that anymore because there's this argument, well, don't you want to own 30% of the asset? No, you don't, because in the end, that NSR, that 2%, ends up being worth more in the current markets than your equity stake, because everybody's waiting for you to go to the markets to pay your part of the joint venture. Better to rest on your laurels, keep the 2% NSR, and then go on to the next one. And then focus your G&A and your management's time in simply always acquiring the next high quality royalty. And also have a team there that's doing royalty generation. And they've been generating new royalties or by acquiring ground with Altius in the Walker Lane belt. And now with the uptick in the market, other companies are raising money to explore their ground, and they retain their 2% NSR. The good thing would be that they do find something and then a bigger company comes in and develops a project. But look, they've still got the 2% NSR. And it's even more valuable now because a big company is actually operating it. And that's why the Silicon project makes so much sense, is because the final developer of that project is the company that owns it right now.
Just to follow up on the Silicon deposit and the Merlin deposit that AngloGold Ashanti has, if you think about that Walker Lane trend in Nevada, it's very prolific. But when they made that discovery, and to some degree Corvus with that Linda Strip, where they had a similar kind of mineralogy, it changed the way people looked at, where to go look for gold in Nevada in that particular area. And you had the Sterling deposit that Core Mining had, which was previously held by Northern Empire, and they eventually acquired that too. And now we see things like Scorpio Gold going possibly back into development and then eventually production. Does a new discovery like that of size, like what AngloGold Ashanti has, change the way all the exploration companies view that area as possibly a new area play?
Absolutely. So Walker Lane has, well trodden, let's say, area. But when you make a new discovery in a place that has been walked over, it always excites people, because when they see probably one of the biggest gold discoveries that's happened over the last past few decades, this is huge. And it's still not been bounded in terms of size, because they have a bigger land package and there's other targets that they still have to drill. Because when we looked at it first, I didn't think it was more than 3 to 5 million ounces, and most of it was silicon. Merlin has ended up being bigger than silicon. So you have a little bit of the Kamoa-Kakula thing going, where Kamoa was the big deposit that Ivanhoe had, and suddenly they did some drilling, and then Kakula ended up being better. That's exactly what happened here with Merlin and silicon. And so that excites the entire area. And so if you're a junior explorer going, to the markets and saying, oh, I want to go raise money. Why are you raising money? Oh, I'm going to raise it to find another ratty, marginal, supposed high grade deposit that never makes anybody any money. It's very low tonnage and not very hard to find the grade here. Or you can say, I'm going to go look for something like these guys have found that's almost 15 million ounces. Well, that excites people more, and that you can get money to do that. And so for them, it's about selling the story. And now they have a better story to sell to get money and then they can have a geological model and say, look, we're in the same caldera setting. We're in the same sort of units. We've got similar looking structures, and we're going to drill those. And they use this kind of geophysical method, and they got these kind of anomalies, and we see the same sort of thing. And so people will give you that money for that analog, knowing that the potential reward is huge.
All right, Joe, thank you so much for your time. It's great having you on the show, especially in an environment like this where markets, the metals, the commodities broadly are running higher, and the stocks are also taking notice. Now, again, these stocks, a number of them and the ETFs are well off their highs as these metals are breaking out, some of them to all-time highs. So I think we're just all still hoping and watching the money continue to flow into these stocks and push them higher as interest continues to grow. Now, a lot of these companies have money, so let's see what they do with it. Again, you want to follow along with Joe, go check out the Exploration Insights website, which I will link to in the posting. And Joe, we'll chat again next month. Thank you so much for joining us on this weekend show.
Great. Thanks a lot, guys.
Al Corlin's firm, A.B. Corlin and Associates Incorporated, provides consulting services to public companies on matters of regulatory compliance. To find out more, follow the link from www.kereport.com. The Corlin Economics Report will be back after this brief timeout.
All right, welcome back. Continuing to listen to the weekend edition of the KE Report. And as promised, we're now shifting our focus over to the energy sectors. We're chatting with Dan Steffens, president of the Energy Prospectus Group. We're going to cover the recent pop in the natural gas price, oil continuing to be stuck in its range, but that range and that price right now, a little under $80 a barrel. We're also going to be talking on the stock front about a pretty significant merger that was announced just last week between SilverBow Resources and Crescent Energy. Dan, let's kick it off with the natural gas price. Look, natural gas was really just stuck at a pretty depressed price there for most of this year, trending right around, well, under $2, even dropping down to about $1.50 on a number of different occasions. But ever since kind of the tail end of April and the beginning of May, the price has moved almost straight up. The price came into May just under $2. We're already up to a high of $2.80. As we're recording this, we're about $2.78. This is a big change for the natural gas price, also filters directly into the natural gas stocks. But Dan, take us through. What do you think some of the key drivers are for this natural gas move higher, breaking out of its range?
Yeah, to be honest with you, it's way ahead of where I thought it was going to be a month ago. I was using $1.75 in all my forecasts for the second quarter. Now it looks like I'm going to have to raise that to $2.50 or maybe even higher. We could be headed over $3 by the end of the quarter. If we're going up like 10 cents a day, it's pretty impressive. I think what's happened is, first of all, we're getting much hotter weather across the South. So we're ramping up all of our natural gas-fired power plants across the South that we call peaking plants. Some of these really are even don't run at all during the winter. Those peaking plants are firing up. So you're getting a second period of high demand for natural gas for power generation. And then I think also this first big LNG facilities down in Plaquemines, Louisiana looks like it is going to come online here in another couple of months. That's going to add 2 BCF a day of demand. But I think the big story that's now getting around, I was at an energy conference. I spoke on Sunday, the 19th in the afternoon. I was the opening speaker. And then the next guy after me brings up about how this artificial intelligence data centers are going to just be electricity hogs. And they are planning to build like 20 or 30 of these just in the state of Virginia. And they're trying to fast track some nuclear facilities up there. And when's the last time we built a new nuclear power plant? But the way I see it, looking at this thing, if you need to increase the electricity supply by 25 or 30% over the next 12, 18 months is what the only way to do it is with natural gas fired power plants. And even then, you're going to have to really kick it into high gear building these things. And I've heard that the AI companies are contacting the gas producers directly, see if they can get direct supply contracts to lock in the volumes and stuff like that. And they're literally talking about putting their own power plants right next to these data centers. So I don't know how this is all going to physically get done in time, but it's really become a big story just in the last 2 or 3 weeks. And so that's what it looks like. To me, it's driving this.
Yeah, Dan, it's fascinating because we've made the exact same point with you on different shows about all the energy that would be needed for electric vehicles. If everybody starts going from internal combustion engines to plugging into the grid, if you start taking all of your lawnmowers and weed whackers and turn them into battery-powered things that you need to charge, Well, then there's also the cryptocurrency miners that are going to be power hogs as they do all that, the data centers. Now there's all these AI data centers. I think maybe it's the straw that broke the camel's back, and finally people are saying, wow, we're just going to need a lot more electricity, and nat gas is sitting front and center. Do you think that this is a sustainable price rise, though, because it moved up so quickly, or do you expect it to maybe level back off a little bit, or could we just keep punching higher here? What's your outlook on where the pricing trends may go?
Well, when people get past this fear that the storage is going to fill up, and they're building more storage, and we're going to need a lot more natural gas. If our electric power generation really does need to go up by 25, 30%, that's huge. And there was a report that just came out from the National Energy Requirement. Anyway, there's some organization that published a report just like a week or so ago that said there's 17 states, including Texas, that are going to be facing potential brownouts and power shortages this summer already. And even without this, we need to get it together, and windmills are not going to do it. And the wind projects are all getting canceled because of the higher interest rates. They can't handle it. And people have figured this out. They're talking about having to open up some more coal-fired power plants or something to meet the demand. So it can turn really fast. And anybody, you can just go look at a 10, 15-year chart of natural gas, and there's a couple spikes in there to $13. So it's still, even if we went to $5 gas, look at it this way, six MCF of gas has the same power energy content as a barrel of oil. So even at $5, that would be the equivalent to a $30 oil price. So we're just blessed to have in all of North America, we have the lowest power costs, the lowest home heating bills in the world because we have these massive resources. So we can handle $5, $6 gas, and that's really where it probably needs to go. But the companies themselves, if they just get back to $3.50, $4, I can tell you, they're going to be happy as a clam. Two was a really good year for the gas companies. And for that year, the gas price averaged like $4, and it was a really good year for those companies.
Dan, that's what I wanted to ask you here is that as much as we've seen this rise in the last, let's call it a month, the natural gas price is pretty much back to where it started the year. And it was only about 2 weeks after the start of the year that it had spiked up to about $3.40. Now, again, the highs can be in the teens with some of these spikes in natural gas. But when it comes to the natural gas companies, I'm sure they're doing better financially right now. But what prices actually does incentivize them and bring in more investors to get them focused on growth and have them feed more natural gas into the market?
Yeah, and EQT and Chesapeake are two of the largest. They are the two largest gas producers in the country. And they have actually choked back some of their wells. And then I follow several other large gas producers like Range Resources, Antero, and they've really reduced their drilling programs for this year. And they're not, and even the ones where they got drilling contracts, they're drilling the wells, they're casing the wells, but they're not completing them until the gas price rebounds. But by rebound, I think once it gets over $3, then they'll bring on production and stuff. They're very profitable at that price. But here's the problem. We have pipeline problems. There's not enough pipeline capacity to take away all of West Texas, all the Permian Basin. The pipes are all full. They can't really produce any more gas. So what we talked about, I think the last time I talked to you guys, there's more and more of the operators talking about putting their own power plants in the field to just use the gas right out of the ground and to generate their electricity within their own field. So they have these modular generating facilities and stuff like that, generators they can install out there to produce their own electricity, so they're not just giving it away. Several of the companies actually have negative gas prices when you subtract their processing fees. But it's the same way. The largest, most important natural gas resource in North America, in the world actually, is Appalachia, where the Marcellus Shale, Utica Shale are, Pennsylvania, Ohio, and West Virginia. And they are pipeline constrained. They need more pipelines. And they're specifically these AI facilities that are going to be built in Virginia. They're opening up that Mountain Valley pipeline finally, after the government finally gets out of the way. So that should be opening here pretty soon. And EQT is going to actually be the one, after they're in the process of making a merger with a midstream company. So they're going to be the ones control the Mountain Valley pipeline. But anyway, we can't build production unless there's takeaway capacity, because you have to immediately hook these big gas wells up to a pipeline, you can't truck it out of there.
Well, Dan, when you think about the investor opportunity in nat gas, we were asking you a couple months back, is there a contrarian opportunity here? Even despite the move up in gas prices, some of the stocks haven't responded as much as one would expect. Do you still see there being upside in some of the gassers? And is there also opportunity based on the pipeline limitations on some of the energy service companies that relate to the market?
Yeah, but the large gas companies, or gassers we call them, if you take EQT and if you assume that gas is going to consistently be above $4, there's tremendous upside. That stock that's in the 40s now could go into the 60s. I could see 50%, but it's going to start getting around. Hey, actually, this merger that we're talking about, those two companies produce a lot of gas, and they have a lot of leases out in the far western half of the Eagle Ford that are really just huge gas reserves out there. Webb County, which sits on the border right between Texas and New Mexico, is a major gas field that even EOG considers it like a world-class gas resource out there. But again, you just got to have some pipelines to bring it all the way to the coast.
Well, and that's the other aspect too, right? Is a lot of these oil companies also have a natural gas component to them, so they benefit from this rise in price as well. But hey, we're a month into this breakout, at least that 3-month trading range that it was in. So if it keeps going, undoubtedly that'll bring in some more money. Let's also talk about oil, because that is, again, still stuck in its range right now, trading just under $80 a barrel, $78. It's been fairly stable in terms of price, and at these prices, companies can still generate some nice free cash flow. What is your outlook for the oil price?
Yeah, well, I think the oil price, I'm using 82.50 now in my second quarter forecast, because we did get to 87, and April was up there in 85 range for a while. And unless oil stays down this low, I think we'll be above 80 for the quarter. Then I've got 85 in the second half, because we're heading into, with Memorial Day weekend here with us now, we're going to be using a lot of transportation fuels. And another thing, they have to use more black oil and summer blend gasolines in the United States. Winter blend gasolines can have up like 10% butane in them and stuff like that, but you can't do that in the summer months. So that alone increases oil demand. And if you look even at the EIA website, they're forecasting that global demand for oil exceeds supply during the entire second quarter. And so inventories will be going down around the world. And then they've got it super tight in the second half. Demand cannot exceed supply. At some point, you don't have any storage left. So at some point, supply actually caps demand, no matter how high the price. And then you start the hard rationing by price. But I'm still pretty bullish on oil, and definitely, even if it stays in the 75 to 80 range, they're very profitable. And the one reason they're profitable is actually completed well costs have come down. We're still got a very low active rig count. We're still down more than 100 rigs per day, and the rig count is that's why I don't think U.S. oil production is going to grow much more, because just at the current active rig count, we can't do it. But completed well costs have come down because tubular prices, the casing, the tubing that these wells have to have, has come down in price. You've got adequate amount of completion crews, fracking companies and stuff have lowered their prices a little bit. All the companies in the first quarter reported to me 5 to even 15% decline in their completed well costs. And there's a new technology that's coming. This was discussed pretty extensively at this conference I went to last weekend. And these horseshoe wells, I don't know if you've seen that, but these horseshoe wells where they can go drill out a mile and then turn around and come back another mile. And the turn takes a half mile. So just think it's not like a right turn. And they can drill 20,000 feet of horizontal and case that, and it can really reduce the cost, because you only have one vertical hole, so that eliminates like 8,000 feet of casing. If you had to put 2 1-mile long laterals, but you can put one horseshoe well that does 2 miles worth of lateral, that cuts your cost by 15 or 20% just on the casing.
Well, Dan, let's get into the merger that you sent us over. This is big news, and this is between Crescent Energy Company, traded on the NYSE under the ticker CRGY, and SilverBow Resources, traded on the NYSE under the ticker SBOW. We've talked about SilverBow in the past, and you said it was at an attractive valuation. Apparently, Crescent Energy thought so too, and they are merging. And really, it seems 2/3 of the value being in Crescent Energy and about 1/3 in SilverBow, but they're doing an all shares transaction, and it really creates the second largest operator in the Eagle Ford area of Texas. Walk us through this transaction. Do you like it? What do you see as the synergies here between the two companies coming together in the new pro forma company?
Well, what I really like about it, and both of these stocks were undervalued. SilverBow was trading at half of my current valuation, and that current valuation was just 4 times operating cash flow. It was free cash flow positive. It's got tons of running room. And my valuation was like $63, and the stock was hanging in the low 30s. So about half of my valuation. I knew about Crescent Energy, but I wasn't modeling. It's not one of my portfolio companies, so I hadn't really looked at it. And I really just started building my model on that one. I'm probably going to put it into our Sweet 16 growth portfolio because both of these companies are aggressive growth. They are Crescent Energy. I shouldn't say Crescent Point, but Crescent Point, which doesn't exist anymore. They changed their name. So Crescent Energy is backed by a big venture capital outfit, KKR. They put this thing together a few years ago. They got a top quality management team, but they've been growing through acquisitions, and so SilverBow. So they've both done that, and they're both focused on that Eagle Ford play down in South Texas. And when they combine, this thing's going to have like over 250,000 BOE per day of production. Actually, their first quarter production combined was 257,000 BOE per day, 37% oil, 45% natural gas, and 18% NGLs. But about, I think, more than 85% of their revenue came from liquid sales because the gas price is so low. So that's just the way to look at it. But and they have the ability, both companies have shifted their rigs to drill on more oil-prone areas. Combined, they're running, I think, 5 rigs and 3 completion crews if you put them together, pro forma it. And they should have steady production growth because they have a lot of good quality acreage, both of them.
SilverBow Resources especially, though, you sent us some notes from your report on it. And look, it was the smallest company in your Sweet 16 growth portfolio, but I think it might have been the fastest in terms of growth when you look back at what the company's done in the last couple of years and even what they were projecting throughout this year. Take us through the growth that just SilverBow offers this combined company.
Oh, yeah. And in today's where everybody wants dividends and free cash flow and stock buybacks, that's the thing now. And I personally have made more money off of aggressive growth companies than any of the bigger ones. The stock went from $5.30 when I put it into the Sweet 16. It's up 619% at $38 now. It's up just this year, 30% year to date. In November, at the end of November, they closed what we call the Chesapeake South Texas acquisition. That's how they labeled it. They bought Chesapeake's entire interest in South Texas. And to them, it was really a transformative deal. It added 30,000 BOE per day of current production and a lot of really high quality drilling locations. And in fact, in their first quarter, they reported some of the best well results on these new wells. And just as a standalone company, I was very excited about it. The proven reserves at the end of last year, this included the stuff they acquired from Chesapeake. Their proven reserves, 446 million BOE, 63% natural gas, 21% crude oil, and 16% NGLs. And based on SEC pricing guidelines, which use a very low gas price, by the way. So both oil and gas prices are now higher than what was used in their year-end reserve report. And the PV10, that's the present value of their future cash flows off their P1, just their proved reserves, was $2.7 billion. And this is a company that trades below $1 billion market cap. And companies should not trade. No way should a going concern upstream company trade below book value. And it was trading below book value. Well, now it's about getting closer to book value, but with this merger thing. But I really liked it, up to 91,000 BOE per day of first quarter production. And then they raised their full year production guidance I think they got a good shot at getting to 100,000 BOE per day by the end of the year. And that's just running 2 rigs. So if with this merger and with KKR behind this deal, maybe especially if the gas prices go up, because both of these companies have some really high quality gas reserves down in South Texas. And here's another thing to remember. It's West Texas, the Permian Basin is bottlenecked when it comes to gas. They don't have enough gas pipelines to get their gas out of the basin. Those wells are being drilled for oil, but they also produce a lot of high BTU gas, really high quality gas, but they can't get it out of there because they don't have a pipeline. Now, South Texas is totally different. South Texas is closer to the Gulf Coast. It's got adequate pipeline capacity, and it also has direct access to several of the largest LNG exporters in the country. Cheniere is adding a 3rd or 4th train down there in Corpus Christi, and they have pipelines directly into Corpus Christi, so they can be selling to those LNG exporters. But they don't have any problems. They get much better price. Their gas prices, actual realized gas prices in the Eagle Ford, were like 2.5, 3 times the actual gas prices in the Permian. So that's a big plus for this merger as well.
Well, Dan, it's also fascinating when you look at a merger as to why the companies were valued as they were before it and how it will look pro forma afterwards. And so when you look at SilverBow, first thing in my mind is, why was it so undervalued? Your thoughts there. But then as they come together and they really move from 2 small cap companies into a mid cap, do you expect them to have a better multiplier? Because a lot of times mid-cap get more analysts, more eyeballs, and they just get a better valuation. How do you see that playing out from why were they so undervalued, and then what could their valuation be combined?
Yeah, both of them are trading for only like 3 times cash flow, and that's crazy. You got profitable companies with tons of running room. Yeah, they got a little bit of debt on their balance sheet, but it's definitely manageable. Their free cash flow is more than enough to cover their debt service, and they're both paying down debt pretty fast. In fact, Crescent Energy pays a pretty nice dividend, like a 4% dividend, which they're going to continue They've already publicly said they're going to continue the dividend after they close this deal. But yeah, it's size matters in this business. And one of the synergies that you get you get better rig rates because you're using more rigs. You get better tubular prices. You get better quality completion crews and everything. Size matters in this business, definitely. And in South Texas, they're going to be second only to EOG Resources in size in that basin, in the Eagle Ford play. And which the Eagle Ford play is turning into the Eagle Ford and Austin Chalk play. The Austin Chalk zone sits right above the Eagle Ford zone, and actually the Eagle Ford is the source rock for the Austin Chalk in most areas. And they're getting really good Austin Chalk wells, horizontal wells down there too. And yeah, its size matters and is going to get a lot more attention from the Wall Street gang. Actually, if anybody's interested, the first thing I would say do is go to Crescent's Point website, and you can listen to the replay of the webcast, and you'll see that there's a dozen of the heavy hitters, the really highly respected energy sector analysts were on that call, and they were all seemed very bullish. And Raymond James and Truist Financial have both updated their price to increase their price targets on the company. Raymond James is $17. So the near term upside for SilverBow, because the SilverBow shareholders are going to get 3.125 shares for each share of their SilverBow. They're going to get that. If Crescent Point goes to $17, which is Raymond James' price target, you're talking about SilverBow going to what, 58? What is it? 53. So just multiply 17 by 3.125, and that's the near-term upside that I see for SilverBow stock when it's converted. And my valuation is actually $63 a share. So then if they, in addition to getting the more Wall Street coverage, if their size just makes people move them to the mid-cap category, there'll be more hedge funds that can invest in them. It builds their investor base. It just opens it up. And I think any analyst or any hedge fund manager that looks closely at this company is going to be very impressed, because my pro forma is showing, let's see, that it's going to generate 2.1 billion EBITDA and free cash flow of 650 million. So this is a free cash flow machine for still a relatively small market cap company. Crescent Energy's market cap is just 2.1 billion. That sounds big. We throw billions around, but that still would be a fairly small market cap, and it definitely deserves more attention.
So, Dan, clearly you like this deal. It also sounds like a number of other analysts out there like this deal. Let's just take a step back then, because look, this is a $2.1 billion deal. We have seen a lot of M&A in the energy sector. When you're investing in companies, one, are you looking for M&A transactions to push prices higher? And two, what is your outlook for M&A continuing in the energy sector, especially in the oil sector?
Yeah, there's still a lot of small caps that I think would be attractive targets. And it just depends at some point, does the management team really want to sell out? There was a special situation here with SilverBow. They had an activist shareholder that was trying to take control of the company. So I think Crescent Energy saw the opportunity to come in there and be the white knight and keep them from getting taken over by a bunch of Wall Street guys. That's a way to look at it. Anyway, yeah, I still think there's more upside. I really think there's some upside in these Canadian companies too that are trading for like ridiculously low prices, if you ask me. And maybe that'll pick up. And with the oil price picking up in Canada because of the Trans Mountain Pipeline, that gives a lot of these guys a nice revenue boost too. But as far as at the conference, one of the things they were talking about is there's really not much open acreage. Like the Permian Basin is now totally leased up, where the only way if a large cap wants to increase their position, the only thing they can do is go buy a company because there's no open acreage that they can go lease.
All right, Dan, we're going to wrap it up here. Always a lot to talk about in the energy sector, but now even more so with the natural gas price moving. And you always bring up a number of companies to us on our monthly calls. We follow along with you at the Energy Prospectus Group, and you do a great job of keeping everybody up to speed on changes in companies, as well as sharing your models and why you have price targets where you do. So again, you can follow Dan at the Energy Prospectus Group. We're also going to have Dan on next month, probably around the tail end of next month. So Dan, thank you for taking time on this weekend show. Everyone, thanks for tuning in on this weekend show. Please be sure to go back through our website, podcast, and YouTube channel. Search The KE Report to listen to all of our daily editorials and company updates. Thanks for tuning in, everyone. I hope you all have a great rest of your weekend.
For our upcoming appearance schedule, visit kereport.com. The Corlin Economics Report will be back in just a moment.